Good afternoon, traders. Tim Reset bringing you another market analysis for Monday, June 3rd, 2013. Let's jump right into the ES. Lots to talk about here. I'm going to go ahead and clear all the lines from my chart, and we have the daily ES in front of us. And if we go back all the way to the beginning of the year and draw up the retracement that we had trading in April up to the negative 23 all the way through the negative 61 target is where we've been sitting for the last couple of weeks. Since pulling back, since we did trade up to the negative 61, I went ahead and drew from highs to give us that extension long. That has since failed on Friday and continuing with a little bit of sell-off today as well. So what we have here is a failure of the extension. So I'm going to go ahead and delete that one. I'm going to pull all the way halfway back from the traditional low to high. So instead of drawing the extension from highs to highs, drawing from lows to highs, the traditional 50% retracement drawing. And it's going to be a matter of whichever trades first, whether we trade down to 1608.25s, then I will use that as a long setup. If we trade higher, if we rally a little bit this week, I would be looking for a short setup at 1653. So when we get kind of caught in no man's land here, when we break a negative 61.8, or a 61.8 rather, it's just a matter of whichever trades first. And the short setup I see as more likely to trade first at 1653s, and we do have a nice bed of resistance at that level as well. And you'll also notice that the 1653 short level brings us right down into the 1608 long setup. So that's one of the things that I like to do when I'm going through the charts and the daily levels, kind of forecast out a few options or a few different scenarios that might occur. So as of right now, I would look to us for at least this week to rally up to 1653s and then sell off back down to 1608s. If we go to the daily chart on the SPY, you can see that we did form a hammer today, and so any move above that hammer would indicate at least some short-term bullishness. But the chart is slightly broken now because we have formed a low back here from last week, and then we've made a lower low, and we've also made a lower high. So now the trend has at least shifted in the short term to sideways to down. To confirm the resumption of the uptrend, we would need to break the high from the 28th of May and then pull back and make a higher low, and then taking us higher to new highs. So that's what I'm looking at on the ES. Things have been going things have been pretty good in the ES. If we look at the VIX this last week, we saw a nice little jump up to the mid to upper 20s, or mid to upper teens rather. But again, with the hammer on the daily S&P and ES, we formed an inverted hammer on the VIX. So if we can get some sell-off, and you'll also notice that the highs that we've been making for this year, from the end of last year to this year, the highs have been getting lower. So we are forming kind of a triangle pattern with lower highs, as well as, well, you can look at it two ways. We have a support level here around 1250, and then we also have a, we're also forming higher lows as well. So as we tighten into this range, as we get tighter and tighter into the 14 range, as we converge on that level, we'd be looking for some sort of explosive move one way or the other. And since the VIX can only go, well, it can only go to 0, it rarely ever dips below 10. So, and low teens is extremely low. As the saying goes, when the VIX is low, look out below. Meaning when the VIX is in the low teens, look for a sell-off to ensue. So what I would anticipate here is that we spend the next month or so, or at least a couple weeks, forming a wedge or a triangle here, converging on the 1450 level, and then break to the upside and that would take us into the fall, and hopefully we see some increased volatility into the latter half of 2013. If we move over to the euro, not much has changed on the daily chart, being stuck right between the long of 12 the long of 2883s and the short of 3233s, and that's what we've been sitting in since April. So on the euro, it's mostly been action on the 15-minute chart and the 512 tick chart. So currently sitting in a 29.51. This traded on Friday, and then we came back down and traded it this morning as well. That's come up close to its target. I'm going to go ahead and draw up the next retracement, and if we do trade a little bit higher in the overnight session, I would just adjust the anchor point to whatever those new highs end up being. But currently it gives us a 30.27 long as the next 15-minute setup, and you'll notice that there's no large 50% retracement. They have all failed. So when we fail a long and then fail a short, you don't want to keep trading in the middle of the range. So anywhere in this middle of the range is going to be a danger area on the daily chart. If you're going to be shorting, you're going to want to do it at the 32.33 on the larger time frame rather. And if you want to be going long in the larger time frame, you want to be doing that at 28.83s, that region. So staying out of the middle section really helps to avoid getting chopped up. One last thing I wanted to touch upon, I guess two final things. The first is I put the weekly stocks that I'm watching underneath the link for this video on the member dashboard, so you can find those there. I'm not going to run through all of them today, but something I've been looking at lately has been the weekly ES options. So that's the options on the futures contract. So in Thinkorswim, if you go over to the trade tab and put in /ES, you'll see that you have a whole list of options at your disposal. Everything from the monthlies, which are just displayed in the white letters, and then these red, the red text are the weekly options, and those expire as their name ensues every week. So we have some opportunity here for, I know a lot of traders are trading smaller accounts or are just getting into futures trading and maybe currently already have a Thinkorswim account but don't yet have an options futures account. And one of the things that I've been looking at and playing with is trading the weekly options intraday. So trading the 50% retracements the exact same way as I would place a limit order to buy or sell the futures contract. I'm looking to take the position in the option. So the way the options work for the weekly options on the ES is their value is half of the option price. So the $8 option here, instead of costing $800, it only costs $400 if you were to be filled at that price. And the delta is the important factor to look at. So if you draw up, for example, if we go to the 15-minute chart on the ES, if you were to draw up a retracement and say the 50% is at 1629s, we'll call it 1630s, we'll round up, and the 61.8 is down here at 1627s, you have a 3-point spread between the entry and the stop, so to speak, the failure point or the line in the sand. So instead of placing a futures order and using either a 6-tick stop or placing a 3-point stop, what you could do is go to the weekly option and either look to buy the 1630s when we pull back to that level, or a couple strikes out of the money as we have a target of this, for this example purposes, target of 1643. So you could essentially wait for the pullback, and when we touch down here at the 50% around 1630s, you could get long the 1640 weekly option, and I'm just using the front week at this point, and what your risk will essentially be is the delta times 3, because the delta is how much the option price will change if the underlying moves 1 point. So if we look at that 1640 and the delta is 45, so we'll just call it 50. We'll have a delta of 50, and we have a 3-point stop. That would give us a risk of roughly $150. So in this way, you can get into a position with risking less money than a futures contract. For if you had a 3-point stop on the ES, it would equate to the same thing in this case, 150. But playing with the different strikes, you'll notice that the various different strikes have different deltas. So if the delta was 25, if you bought the 1655 with a delta of 25, and you were risking $3 or 3 points, you would your risk theoretically would be roughly $75. So at the bigger levels and intraday, if you're not comfortable trading the futures contract, or if you you don't have a futures account and you're just looking to get your feet wet, the options could be a really good place to limit your downside risk, while at the same time leaving your upside risk unlimited, because as the position moves against you, your delta is going to decrease. So if it moves against you by $1 and you have the 1640 option at $45 delta, if it moves against you by $1, you might be down $45, and if it moves against you by another $1, you might only be down another $40. But if it moves in your favor, the first dollar increment, the first point, you might make $45. The next point, you might make $48. The next point, you might make $58. And so it's a really great way. Options are a really great way to hedge your downside risk at the same time maximizing your upside potential. So that's something I've been looking at the last couple of weeks. Just wanted to share that with you. I'm going to put together some more information in a blog post with some other videos and things hopefully this week. So with that, I hope you all have a great trading week, and we will talk to you again next week.